Welcome to this Killick Explains video, and welcome to another video where I'm going to reveal the results of a recent poll I conducted. This time the question was all about what approach people take to investing, and I'll reveal the answers and then I'll talk about one or two of them in a bit more detail as usual. So how do stock pickers approach investing? And what I offered was the opportunity to say I take an entirely top-down approach. More about that in a moment. That was around 8% of the responses I got, so not the most popular by some distance. Then I offered bottom-up approaches. More about that coming up. That was 23%, or near enough, of the answers I received, so a bigger chunk. Then I asked whether people blend the two together, and that attracted around 29% of the vote. And then finally I offered people the chance to say, actually I don't do stock picking, so the other three answers are largely irrelevant. I prefer to invest in funds, hand my money over, and that was a sizable minority in total versus the stock pickers of around 40%. Now, what do I mean by these different approaches and how could they be useful in practice? Well, first of all, top-down approaches tend to be where people look to identify trends on charts, often looking for patterns to repeat themselves. History doesn't repeat, but it sometimes rhymes, as Mark Twain put it. So sometimes investors will look to the charts, to momentum. The trend is your friend, to identify what may be about to happen next. And there are certain chart signals, in fact there are loads, that analysts who favour this approach tend to rely on heavily to tell them whether a particular sector or stock is hot or not. Now, to give you just a couple of examples of things you may have seen in the media which are chart related recently, you may have seen talk of cryptocurrencies experiencing the so-called death cross. Now, what does that mean? Essentially, it means that if you look at a short-term moving average, as it's called, that is literally an average taken across a short-term period and then adjusted on a daily basis. So you take the latest reading and drop the earliest one, hence moving average. If you look at that on a short-term basis, say on a 50-day rolling basis, versus a much longer term moving average, say 100 or 200 day, a death cross occurs where a short-term trend line moves down through a longer term trend line where both are already falling. And that, to chart analysts, is an incredibly bearish signal. Bad news. Equally, a golden cross occurs, which is much more bullish, when a short-term moving average line crosses up through a longer-term moving average line and the two are already travelling in an upward direction. All things pointing north, a very bullish signal. Now, that's just two, there are countless others. Now, those people who responded, actually I use bottom-up analysis, are people who prefer to roll their sleeves up and look at companies on their own merits, regardless of any noise happening around them, if you like, and reach a judgment about whether a particular share is good value or not. And there are countless ratios that one can use to do bottom-up analysis, but a good example would be the classic PE ratio, which looks at the current share price as a multiple of 1 year's earnings, either estimated forward or recorded historic for, say, the last 12 months. And essentially it asks whether a company is cheap or expensive by asking the question, how many times 1 year's earnings is the current share price? So a PE multiple of 10, for example, suggests on an undiscounted basis it would take about 10 years to get your money back were you to buy the share today. And you could compare that to a peer group, you could compare it to the wider market and reach some sort of conclusion. But you wouldn't just do one of these ratios, the PE ratio, you'd probably do a whole host of them depending on the company you're looking at and the sector it operates in, because some ratios are more relevant to certain sectors and firms than they are to others. Now that bottom-up technique, looking at ratios, financial strength, brand strength, the size of a company's moat, as Warren Buffett put it, attracted around a quarter of the votes in my poll. Naturally enough, most people who said they do stock picking of some sort would prefer to combine the two. So trend analysis allows people to identify the direction of travel, if you like, at a macro level, as economists call it, whereas bottom-up, sleeves rolled up analysis of earnings, financial strength via the balance sheet and cash flow then adds meat to that picture in terms of which companies are likely to thrive and which may fall by the wayside. Now, in fairness, not everyone is a stock picker, so I offered the opportunity to answer I prefer to hand my money over to a fund manager, or in fairness these days to a portfolio manager who might run, say, a discretionary portfolio of perhaps 30 stocks on your behalf, and that did attract a sizable chunk, around 40% of responses, and that's fair enough. Some people do not feel equipped to do either top-down or bottom-up analysis. They don't have the time, they're not interested enough, and therefore they're quite happy to hand over the responsibility to somebody else to build out a portfolio for them or to construct a particular mandate in the case of a fund manager. But it's important, if you are going to become a stock picker, DIY for example in particular, that you understand that there is more than one approach to identifying the right sectors and companies, and then be prepared to combine the approaches I've discussed in a way that will uncover long-term winners. Now, to find out more about all these topics which I have skimmed through in this video, please do feel free to browse our comprehensive library, killick.com/learn. There is a shares tab, that might be a good place to start. And if you'd like a copy of my comprehensive but easy to read and jargon-free guide on how to invest in equities, then please do email me, editor@killick.com.